Hi everyone, I am Anandapadmanabhan, Assistant Professor, Department of Commerce, Theivanai Ammal College for Women, Autonomous. Today we are going to learn about a new topic in corporate accounting. It's an interesting aspect in corporate accounting which deals with goodwill. Now we need to know what is goodwill and the valuation of goodwill. When it comes to the meaning of goodwill, the goodwill of a company is what it has as good name. Usually, the valuation of a company is based on the net assets or the wealth generated by the company. But the actual value of a company, we can't just measure it in material things only. A company is not just about the brick and mortar or the assets or the money that it generates. It is much more than that. And this value is called goodwill. It is the good name. It is the reputation earned by the company. Now, since goodwill is something that we can't measure in terms of material aspects, it is intangible. It's actually the value of business over and above the value of its assets. In technical terms, we can say that it is the difference between the purchase price and the value of the assets. Maybe the value of assets of a particular company would be 10 crore, but the purchase price for that company in the market would be around 25 crores. This difference between purchase price and the actual value of assets, we call it as goodwill. And it has a positive impact for the foreseeable future of the company. Now we need to know what makes the goodwill valuable. Like, what are the factors affecting the valuation of goodwill? Now there are several factors which contribute to the goodwill of a company. Such factors include good public relations. That is, how the company deal with the public, what image or reputation it holds before the public. Now another important aspect that contribute to the goodwill is regular customers. Over the several years of its existence, a company might have generated several trusted customers. Now these customers are an actual goodwill. These customers who trust that brand and devote themselves to this company are an asset which is invaluable. This also contribute to the goodwill. Now another important aspect is quality product in reasonable price. A very important advantage of a company that has been in existence for a so long period of time is that it has the ability to provide goods at a reasonable price without compromising the quality. Now that is also a goodwill. The brand value that it holds in the minds of the customers is goodwill. Another important aspect is management skills. The success of a company or a firm is highly dependent on the skill of the management of its managers. It's also an important goodwill. So again, none of these factors I have enlisted are we can't just measure them in monetary terms. Okay. Now another term is location of business. Most of the companies or firms have an advantage over its competitors if it is well located. The location of a business is very important. The accuracy or the proclivity towards the suppliers and customers are very important in the location of business. Now another important aspect is the good supplier relationship. The relationship the company holds with the suppliers is also a very important wealth which we can attribute it to the goodwill. Now the last point and very important point is the employees. The employees of a firm or company would contribute so much to the company that their value or skill is invaluable. It also contributes to the goodwill. And we also know there are certain companies that insure their employees as key managerial employees because their service is invaluable. And yet again, we call it as goodwill. Now coming to the accounting aspect of valuation of goodwill, we have four major methods of valuation of goodwill. First one is simple average profit method. Second is super profit method. Third, weighted average method. Fourth, capitalization method. The capitalization method is yet again divided into capitalization of average profit method and capitalization of super profit method. First thing, simple average profit method. In this method, as the name suggests, we consider the average of profit, the simple average of profit over the years. And coming to the formula, we can see goodwill is equal to average profit in the number of years of purchase. Goodwill is the product of average profit into number of years of purchase. And when the average profit, when we comes to average profit, it means total profit divided by the number of years. We take the sum or the aggregate of all the profit over the years and we divide it with the number of years. We get the average profit, and this average profit we multiply it with number of years of purchase to arrive at the goodwill. The number of years of purchase, we may get one may wonder what is the number of years of purchase. It means the number of years for which the firm is likely to earn the same amount of profit. How long this company or firm will earn this same profit or the similar level of profit for the foreseeable future. That is the years of purchase. Now the things to consider before calculating the average profit. This is important because while calculating the goodwill, we need to be careful while computing the average profit. Average profit is a profit that is occurring in the ordinary course of business. It's the normal profit. We should only consider that. Hence, we have certain conditions. The first condition is any abnormal profit should be deducted from the net profit of that year. Maybe the company have made some abnormal profit in between those years. An abnormal profit that is not usual in the ordinary course of business. In such cases, we need to deduct or exclude that abnormal profit while calculating the average profit, because it's not usual that the company earned that much profit. Now the second condition is any abnormal loss should be added back to the net profits of that year. Maybe the company has suffered some accident or fire accident, some loss of goods, unusual events. Now such events should not come regularly. So we need to eliminate that also. Any abnormal loss should be added back to the net profit while calculating the average profit. So first we need to deduct any abnormal profit. Now then we need to add back any abnormal loss that have incurred in these over the years while computing the average profit. Now the third aspect is non-operating incomes. Non-operating incomes are incomes that are not related to the course of business, ordinary course of business. The main activity or the core activity of the business is not related to non-operating business. So non-operating incomes should also be excluded. An example of such non-operating income is income from investments. If we have included it in the profit, we need to exclude that in order to find the average profit. Now based on these accounting concepts, we can see how we solve an illustration, a very simple illustration with regard to the goodwill computation. Following are the details about Alpha Limited. Profits for 2010, 2011, 2012. 3 years are given. Profits, and the second point is profits of 2010 have been reduced by 15,000 because goods were destroyed by fire. Now we have a 15,000 loss in 2010 which is owing to fire, destroyed by fire accident. Now we know it's not common for the fire accident to occur every day in a business. So you have to keep in mind it's an abnormal loss, right? Yes. Now another point, non-recurring income of 10,000 is included in the profit of 2011. In 2011, there is a income that is crept in the income, in the net profit, which is a 10,000 rupees, a non-recurring income. It's non-recurring by definition. It's not normal. We need to exclude that income while computing the average profit. Now the next point is profits of 2012 include 10,000 income from investment. Income from investment is 10,000 is included in the profit. Income from investment, we have just discussed that income from investment is a non-operating income and it does not constitute the net profit. So based on these informations, we are asked to calculate goodwill on the basis of 4 years purchase of the average profit of last 3 years. Okay, you should not get confused. You need to find the profit based on 4 years purchase and the average profit for last 3 years. 3 years profit are given. Now moving on to the computation. Yes, for profit for 2010, 1 lakh. We need to add the 15,000 because 15,000 we have an abnormal loss owing to the fire accident. 15,000 we need to include that because ordinarily, usually we do earn that income. Now the second year's profit of 2011, 1,20,000. We need to deduct 10,000. We know we need to deduct the 10,000 because this 10,000 is owing to a non-recurring income of 10,000. Non-recurring income we can't include in the computation of average profit because it is not normal. It's not normal. Now profit of 2012, 1,40,000. We need to deduct 10,000 because income from investment. There is an income from investment amounting to 10,000 rupees. We need to reduce that. And based on these adjusted profits or modified profit values, we find the average profit. We know how to find the average of profit of 3 years. We add the profit of 3 years and divide it by the number of years. Now what are the profits? 1,15,000 plus 1,15,000 plus 1,30,000. Total is 3,60,000 divided by the total number of years. Total number of years is 3 years. Now 3,60,000 by 3, which is 1,20,000. Now while computing the goodwill, what is the formula? We could go back. Yes, goodwill is equal to average profit into number of years of purchase. We have already computed the average profit, which is 1,20,000, and number of years of purchase we have, which is 4 years. Now 1,20,000 into 3 is equal to 40,000. Now the next method is super profits method. Goodwill is calculated on the basis of super profit. In the first method we were having average only. Now in this second method we are going to find the super profit. Goodwill is calculated on the basis of super profit, that there is the excess of actual profit over the average profits. By formula we have goodwill is equal to super profit into number of years purchase. Super profit. What do you mean by super profit? Super profit is any profit that is on and above the normal profit. Okay, so super profit is equal to average profit minus normal profits. We have another formula for computing the normal profit also, which is capital employed into normal rate of return by 100. Now normal profit is the profit that the company would generate in an ideal situation. In an ideal industry, this particular company with the given resources and the capital employed will generate a certain amount of profit. It is called a normal profit. But our company, the company that we are considering, have generated certain profit. We consider the average profit of that company also. Well, now we need to compare the average profit of the particular company and the normal profit such a company would generate in the industry, and we need to compare both. Any profit which the company generate above the industry norm or the normal profit is called super profit. And in order to compute the normal profit, we need to multiply capital employed with that of normal rate of return. Now another illustration explaining that super profit computation. Average profit we have 60,000. Capital employed 5 lakh. NRR, normal rate of return, is 10%. We need to calculate goodwill on the basis of 4 years purchase of the super profit of last 4 years. Now 4 years purchase and 4 years profit we have. Now average normal profit we need to find out. Normal profit means the profit that the company would generate in an ideal situation in the industry, which is capital employed into NRR 10%, which is 5 lakh into 10%, which is 50,000. Now that is the norm, that's the normal profit. Now when it comes to the average profit, they have already given it 60,000. Super profit is the average profit above the normal profit. Average profit minus normal profit, which is 60,000 minus 50,000, which is 10,000. Now goodwill is equal to super profit into the number of years purchase. Number of years purchase is 4. 10,000 is the super profit. Super profit into 4. 10,000 into 4, which is equal to 40,000. Okay. Now another method is weighted average profit method. This method is the modified version of the simple average profit method. We base the method in simple average profit method and it is modified. In this method, each year's adjusted profits are multiplied with the respective number of weights in order to calculate the total product. Adjusted profits are multiplied with the respective number of weight. We allocate a weight to these average profits. The total of product is then divided by the total weights to calculate the weighted average profits. Therefore, the weighted average profits are multiplied by the number of years of purchase. Now, the formula for weighted average profit is equal to total products or profits divided by total of weights. Total of products of profits divided by total of weights. Goodwill is equal to weighted average profit into number of years of purchase. Now this is very similar to that of simple profit method, only that we allocate weight to the weighted average profit method. Now the last method is capitalization of profit method. Capitalization of profit is very simple. We merely apply the capitalization rate. Okay, the capitalization of average profit method and the capitalization of super profit method. In capitalization of average profit method, the formula is average profit divided by normal rate of return into 100. Now we are considering a rate. We are applying a rate which is called a normal rate of return to find the goodwill. So capitalization of average profit method is equal to average profit divided by normal rate of return into 100. And if we are capitalizing using the super profit, the formula is capitalization of super profit method is equal to super profit divided by normal rate of return into 100. Now that is the two formula for capitalization of profit method. These are the 4 methods of valuation of goodwill, and I hope you have understood these 4 simple methods. Thank you.